Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor. This is Dentist Money. Now, here's your host, Reese Harper.
Welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm here with my trusty old co-host, Sir Ryan Isaac.
Yep.
And as you know, I'm your host, Reese Harper.
Yep.
And today we have our sixth time special guest, Q.
Q in studio.
I'm here.
He goes by one letter because when we first brought him into the studio, he stood at a microphone and was mocked as the Q&A mic guy by Sir Ryan Isaac.
Yep.
We've come a long way since then.
It feels like another life.
And I put my foot down and I said, there's no bigotry and intolerance in this studio.
No.
Are you excited about today's show?
I'm unbelievably excited about today's show.
I'm clenching my Kirtland purified water in hand and ready to go.
Yeah, well, today we're gonna talk about something that comes up a lot in financial conversations in general. And it's kind of this topic of you hear something that seems like it could be really good advice when it could be not only not good advice, but maybe bad advice or dangerous advice.
So we'll say today we're going to talk about maybe the warning signs, how you know you're about to get delivered a fraud, like some kind of crazy piece of advice, or something that just might be bad. I mean, this is just the warning signs of bad advice.
Yeah, and here's the disclaimer I would make. Are you going to hit a C for Chi? Are you going to hit a chime on this?
I'm going to do a G.
It seems like you were ready.
G for good advice.
Okay, G for good advice.
You're going to be getting good advice today.
The disclaimer I would make is that, because we get this sometimes where we tell a story where it could be an actual story, but that's like really common because we're not going to use a lot of people's personal stories on here.
It's too hard.
But it is too hard. But I would say that if you hear any of these stories, like I got pitched that the other day and I was just telling you about it. It is not unique to just one person. So if you hear one of these stories and it's like, hey, that was my story, I just told you about that last week, you're probably like the 20th person that said that exact same thing.
Yes, these are the most common warning signs of bad advice, and they have to have been at least repeated 10 times within one calendar year
before we can tell the story.
Make it on the show.
Because then no one knows who they are.
So you're basically saying, don't feel like you're that special.
We're not, okay. That was a long way of saying we're not singling anyone out, okay? Yeah. These are common things. We're going to start with a little bit of a story. I went and I was looking, I went to the SEC's website and they report scams and frauds.
The SEC, for those of you who do not know, is the Securities and Exchange Commission, the government body that regulates investing.
Yes.
I was giving that for you,
Thank
Q.
you, yeah.
Q was
you beat me to the punch on that one.
Yeah. You were thinking football?
Yeah. I was thinking
like Bama.
Southern, what is it? The Southern
Exchange Conference?
The Southeastern Conference.
Yes.
LSU, Alabama.
Yes.
All the good football
I was
teams.
thinking LSU right when
the
you said
big
that.
games. Okay. All right. I went to the SEC, non-football, the government regulating investment body. I went to their website because I was looking for. I wanted to try to find like the most outrageous claim of a scam that actually worked on some people. Unfortunately, and I found the stories from 2011. There was a guy in Atlanta, and he had. It was pretty vague. I don't. It's just crazy to think of how you would get into this, but. He had this secret and risk-free trading platform that involved transactions between international banks. That's it. That was like the description of the thing. So arbitrage between banks and pricing. I don't know what it was. Currencies. Yeah.
Just throwing that out there.
Could have been currencies.
He probably was throwing that out there.
It was supposed to generate substantial return on a recurring basis. The substantial return, though, his promised substantial recurring return was 300%. Every 14 days.
Seems reasonable.
It's extremely reasonable. If you do the math, the formula to take that 14-day return and turn it into an annual calculation, your annual return it's like in the trillions.
Okay, it's just over $1 trillion annual return.
Percent. Yeah. It's insane. And
you wouldn't have thought that, though, by looking at 300% every 14 days. That it would be that insane.
No, I mean, it's still 300 is still crazy.
It's like you're just going to triple your money every 14 days.
You would, yeah.
It's not that doesn't seem
Totally.
that sketchy.
Totally normal.
Okay.
So this guy, I mean, and it wasn't like Bernie Madoff.
My point is I'm making that sometimes when people list returns in an individual number, it doesn't feel like they're going to be that outrageous.
Okay, I'm glad you're saying that. I thought you were being a little sarcastic, but
I was, but
but what you're saying
in
is
a truthful way.
Because you hear 300% and your brain kind of goes, well, that's really high, but that's probably doable.
Yeah.
If this guy's really smart, that's probably really happening.
Yes.
So anyway, it was a few $1 million and he had to pay a lot of it back and got in a lot of trouble. But the first thing we're going to talk about is one of the warning signs of bad advice, or maybe something even worse, like a fraud or a scam, would be when someone's leading with some outrageous return claims.
Yeah.
Here's an investment opportunity and the return is X, and you kind of hear it and go, it seems.
Well, 300% is the exception. Usually,
I found it. Yeah,
you did.
It's a pretty extreme,
and I congratulate you on that.
There's a list of them. There's a lot of them.
You deserve a C for chi.
Thank you.
But here's the thing. If you look at the normal claims on returns, usually you'll hear someone say it's like 8% or 5% a month.
Mm-hmm.
Or, some like reasonable single digit number per month.
Okay.
That's I see that all the time. Like 8% a month, 11% a month. It starts getting crazy, but you hit 3% a month, 5% a month, 8% a month.
Well, you had a conversation about it was a $7,000 return from a $180,000 investment.
Yeah.
Monthly return. It was like 3.89% per month. That's what it came out to.
Yeah, it ends up being like, but see that's a totally different way like shocking returns are presented. One of them is a per month percentage. Someone says a per month percentage and you don't really do the math. So take a 12% per month return. That's really a 290% annual return, right? And you've seen lots of situations, and I've seen lots of situations where people say 10% a month, 11% a month.
It's not
a month.
uncommon.
No, I probably bet this year I've probably had it happen at least a dozen times.
Yeah,
this trading strategy that someone's implementing, or this currency strategy, or this play on commodities, or this oil and gas play is giving me 10%,
12%,
12% a month.
Which seems, when you do the math, it's like that's kind of insane, but.
When you do the math of an annualized number, it feels insane. But when you hear that number on a monthly basis, sometimes you don't know how to quantify that. As a normal person, when you hear 7%,
we pointed to Q when he said normal. We
I'm
looked
the normal
at Q.
person in the
You're
room.
the normal person.
You're the normal guy in the room. Jeff's pretty normal.
If you if you hear 7% a month, you're not going like that's impossible.
If you don't spend your days in finance and looking at investment returns and different investment opportunities, that could seem
Let's
rational.
just say someone gives you that 12% a month.
Mm-hmm.
Okay, it's a high number that we hear a lot. If you put in, let's just say you put in $50,000 into that.
Okay, yeah, your 12% a month, which equals 290% per year. Your $50,000 turns into $45 million after 5 years.
Now repeat.
$50,000 turns into $45 million after 5 years of investing.
Yeah, and it would be, and if we move that number down to like 10%, 8%, you still have tens of millions of dollars on a $50,000 investment in a very short period of time.
You basically become like the world's wealthiest person in a decade.
Yes. You'd own most of the public companies.
You could buy Amazon from Bezos.
Yes, you could on $50,000 investment.
Yeah.
Another way that you're told shocking returns, that was our first kind of point, is someone's going to tell you a shocking return. That's how you know it's bad advice. When they lead with the shocking return.
Yeah.
Another one was someone came in and they said that they were going to receive $7,000 a month from a investment of $180,000.
Okay.
And to this person, that monthly return it seemed high. This person's a sharp person. They hear this number. They weren't like, oh my gosh, this seems like
you nut.
This was like, they were like, this is pretty aggressive.
It's aggressive, but
it seems possible based on the story I was told.
Okay. Yeah.
And if I put in $180,000, I'm going to get $7,000 per month. And I said, well, that's about 4% a month. That's about a 60% annual return.
Yeah.
Does that smell right to you? 60% annual return? He's like, well, I don't think so. That doesn't seem right.
Yeah.
Right. That number doesn't seem right. And I'm like, well, if we did that, your $180,000 that you put in, you're going to have, almost $2 million in 5 years.
Yeah.
Do you think that's normal? Is that
It'd be
sustainable?
awesome.
Yeah, it'd be great. What kind of thing was it? And it led me to ask some more questions, and it turned out this was a real estate project. Which anytime I see a real estate project with those kind of numbers, I'm like, that's never going to happen. Like real estate is a market that's much more rational
and steady.
And you can have high returns if you go and buy a raw piece of land that's never been zoned, develop it, and carve it out for condos and sell it off. If you go from, a piece of sagebrush land out in Orange County and you flip that thing because you knew some way to get it through the city magically. Yeah. I mean, there's some big returns, but they're not 60% annual for 5 years. Like that would be like someone,
So the train of thought here has to be either A, this is bogus, B, maybe it's happening like for 2 months, but there's no way this is going to continue. Like you can't plan on sustainability with anything. Even if it's true, even if you saw proof of it, you can't plan on it continuing.
Yeah. Like a company like Facebook might have a period of time where in its really early years.
Sure, yeah.
Where for the first, where Mark Zuckerberg in the first 5 years of the business, he started getting capital, the business had exponential growth for a very short period of time. But it wasn't something that he understood was going to happen. And he didn't really know what kind of exponential return would happen from it. And consequently, he didn't know what value to place on it. So someone might have got that return, but it was an accident more than it was like a conscious, Mark Zuckerberg saying, sure, I'm going to let you make 100% return for the next 3 years.
Yeah. And we're going to replicate this forever.
Yeah. I mean, you just look at Facebook's returns over the last, since it's gone public, and you're getting to a more rational kind of place.
The more time goes on.
Yeah. And so think that if someone gives you a disproportionately shocking return, kind of run the math on it, or ask someone, call into Sir Ryan Isaac and ask him to run the math on it.
833 DDS plan.
Even Q likes running the math on this stuff. He's actually a finance whiz. So people wouldn't really know that, but he can build spreadsheets to analyze the return on your little investment here.
Here's what I would say though, just as we finish up this first part, as a caveat to that. Sometimes people say things to you, like they'll present an investment opportunity, or they'll say, I invest in this thing and I get 12% a month. Sometimes they just don't know that that's not true too.
Yeah.
Like we've heard those stories where client will say, my buddy's getting X% per month on this investment, and it sounds pretty good, and I know it's legit. I know the people running the thing, and it turns out that that's just not true information.
Yeah.
The friend doesn't understand that they're getting 12% a year, not per month, and that happens all the time too. So
yeah, that's true. Okay, number 2 warning sign.
Yeah. This we talked about this a little bit before, but when somebody leads with you should do this thing, or buy this investment or take part in this thing because of who's involved. You know,
because of a high profile person
or organization or something.
It's like this person's behind that investment.
Mm-hmm. Now
this is the Tony Robbins.
It's the Tony Robbins flip.
Yeah, this is the
thing.
This is the
Tony Robbins trade,
the Kiyosaki trade.
Mm-hmm.
Okay, this is the only he can do.
You want to
that.
be rich dad or poor dad? Which dad do you want to be?
Yeah, so
I want to be like mediocre dad.
Personally, I nothing against either of those two people.
We're just throwing out weird names.
These are names. This is a lot of times when you'll see people, it's a very common tactic to lead with the name of a credible person so that investors kind of bypass the more rational math that has to happen to make an investment decision, and they just get behind the person.
Or it could be sometimes it could be like a very completely unrelated party. It could be just like a rich local athlete that made it to the pros once and still lives in your local town. It's like, well, he's part of it. You know who that guy is, right?
Yeah.
He used to play for so-and-so. He lives there and he's got money in that thing. So
totally.
We're good. This type of thing is really common with what's called affinity fraud. And affinity fraud is where it's one of the SEC's, again, the SEC top frauds or types of fraud or scams. It's where you have someone in a position of trust. A lot of times it's in religious organizations. So in pockets of the country or the world where religious organizations and culture are really tightly knit, it happens a lot. Like the SEC has a list of affinity fraud scams that they've busted, and prosecuted people for. And it's kind of crazy. There was one, I found one of these where it was an ex-military guy, and he raised a bunch of money, and had this proprietary day trading kind of thing, and he just went and spent investors' money on like a lavish lifestyle, mansions and cars and clothes. Kind of, he looked like Q, basically,
more
like all the
Q's
nice
lifestyle.
stuff. Yeah,
High
Q's
roller.
lifestyle. Yeah.
10-4.
But he just went through his ex-military community, and he was a respected person. They had something in common. They both served in the military, and he was able to raise a lot of money. His promise was 200% annual returns. That was his promise. But he stole a few $1 million from people in his community and
The ex-military community.
Mhm.
Yeah.
You see this in, like I said, religious organizations. You'll see this in, it happens a lot in refugee organizations. So on the same website, you'll see, like down in Florida, where you have a lot of populations coming from other countries and that live, like in the Cuban community. There's a lot of fraud that has happened in the Cuban community throughout Florida, a ton. So
happened to in Idaho. I wrote about this in a Dental Town article a few years ago, where between Thousand Oaks, California, and southeastern part of Idaho, almost $800 million was roped into fixing up old businesses and putting them back on the market, and
like buying some value stocks.
Yep, except private companies helping them out, and it was like, it's just one of the biggest Ponzi. I think it's the 7th largest Ponzi scheme in the history of the U.S., and it happened in the Mormon community inside of Thousand Oaks, California, and southeastern Idaho. It was like church people telling church people about what they were going to, what they were doing with their money, and
and it's common. You'll hear, so and so is a leader in the community or a religious leader in my church, and you'll hear people just kind of point to that and then stop asking questions. And so I guess that's the point of this one is you can't just hear a name that's involved and then just assume that everything is fine or that it's appropriate for you, even if it is legitimate. That's can't be.
Don't trust that source too much. Don't like let the fact that just because that's also a good thing. I mean, if somebody like credible is actually involved, like a credible financial mind, like if Warren Buffett buys into GE stock, you're not like, it's Affinity Fraud. Warren.
He's just getting his group of
Sage of Omaha is getting played by GE.
Yeah.
So I'm just saying,
The Oracle of Omaha.
yeah, the
Oracle.
Sage.
Just had to correct you there.
Thank you. The Sage. Where's this coming
It seemed
from?
right. I disagreed.
So ultimately, though, you don't want to put too much emphasis on that, because that even if it is someone very credible, sometimes they get it wrong. Sometimes they don't do the appropriate amount of research. What number of reasons they have to do it that could be.
Well, how many famous or rich people have been also scammed?
Yeah.
I mean, you hear about that all the time.
I hear quite a bit the comment like, well, can you just tell me what you find out? And once you know, then I don't have to.
Yeah.
Right. And I'm not saying
I've said that to you probably 10 times before.
I've said that to other people.
Various reasons.
I've said that to other people myself.
I want to buy a mountain bike. Will you just tell me what you
Yeah, like
you spent
which
like
one?
4 years researching mountain bikes. You just tell me
I
what
think
to buy.
there's just an allure to like not having to do your own due
sure,
diligence.
yeah.
The problem is, if you don't do your own due diligence, you will not ever forgive yourself if you get it wrong. It's like when it comes to big financial decisions. Okay, let's go to number 3. Book 3.
Yeah, book number 3.
If the advice you're being given is a huge deviation from a current plan that you're executing, and I would say that it's a thoughtful plan that you have implemented.
Yes.
If your current plan that you have is like
Also not a good plan.
also not a good plan, then I wouldn't make this apply. But if you have a good plan and you have spent lots of time and asked a lot of experts and feel like you have multiple people saying what you're doing is a good plan, whether that's like, the real estate you're about to buy or the practice location or the associate you're about to hire or the financial plan you're going to make or the tax filing, that you're doing. If you've really had a good plan, but someone then comes and says something that's a huge deviation.
Yeah, it's totally different.
And it doesn't like seem, it feels compelling. So it's like, oh, how did I not know about this secret other plan?
Yeah, mine is like trudging along, but it's not flying.
Yeah.
This other way.
If it's a big, deviation, then you should probably think twice about following that advice.
something can come along though where someone goes, my 25% of income that I'm saving that's going to this kind of plan that I'm doing, if I just diverted it here, my return would go from 8% to 30%, and then I retire at 52 instead of 61, and and then what to your point, you just kind of have this deviation from what was rational and what was diversified. You kind of had your risk spread in different places. It was accomplishing different things. You're building liquidity, you're lowering your tax rate, and then you just take all that money and shove it into some investment that's supposed to be riskier and higher return, but it's a complete deviation from what that's just kind of a warning sign that it's like, what you were, if it's totally opposite from what you were doing before, that should give you pause.
Yeah. I would say that totally applies to investing, and it also applies to other big decisions that you're making.
Like business?
Yeah, I just think in your practice, if what you're about to go and do is a big deviation from what you've been doing
and what's working,
but it's a big pivot, you should just do incremental change is always better than huge change. Like this morning, I got a phone call from, this is back to the investing kind of conversation, but this morning I got a phone call from a client while I was driving to the office. It was at 4:30 a.m., really early coming in. Just the crack of the light had yet come over the mountains.
This is after you baled the hay?
This is after we went on I was at an exercise already for an hour.
Okay.
So I was really tired. And I'm driving down the road to the office, and I get a call, and it's from a client, and the client says, "Hey, one of my friends is in trouble." And I'm like, "Okay," and says, he just called me, and he said that his financial guy is telling him to take his money and almost all of it and put it into this deferred annuity. He should just go put it all in this. And this guy's a successful person. We're talking millions of dollars. He's going to pivot and shift into an entirely new strategy. And person had like kind of a more, I'd say, diversified mix of different type of accounts, kind of a more rational approach from what the client thought. Mm-hmm. And the client that I was talking to, my client, was telling me that he was worried about his friend, and he wanted to know if he could call my cell phone.
That's a
He's
good
like,
friend.
"Can I just have him talk to you?" Because he's like, "It doesn't smell right to me." I'm like, "Dude, way to go! Way to reach out, defend your friend." And
notice a red flag. I mean, he's noticing something here. Like, you're about to pivot into this thing that's totally opposite. And very concentrated too, which is
and good for his friend too. It sounds like he must have had a little bit of pause, in order to ask, or talk to his friend about it and see, maybe you should get a second opinion. And I just thought that was like kind of amazing. Like how many times does that not happen though, where there's this really compelling like pivot, really compelling big deviation from current plan, and then it results in someone actually implementing that new strategy and never really actually questioning it or getting a second opinion or having a few set of eyes go over it. And next thing you know, they just get taken advantage of. And let's go into book the next chapter of our story.
There's some good working titles for this one.
Yes.
But this is just the gray area pitch.
Let's talk about this next piece of bad advice. When someone tells you this is something that's a bit of a gray area.
Okay, first of all, one of my biggest pet peeves in this is that it's usually preceded by a pitch on like touting their audit defense record. Hey, just before we talk about this, I just want you to know this is a gray area, but our audit defense, we've been audited 1 million times. We win every single one of them.
Yeah.
Like, should you maybe not be doing the thing that's making you get audited so frequently? You know how many times I've heard that where in the sales pitch, like point number 2 is that their audit defense is really stellar,
or that it's a little loophole that we've found, little tax.
Okay, so let's talk about gray areas, loopholes, the things the big boys are using that now the small guys have latched onto.
Yeah, I'd like to talk about the life of an outlaw in the gray area, working on secret loopholes. That's kind of the kind of tone. So if you hear someone talking like this a little bit, if they invoke the power that they've had to overcome the government and the IRS to defend you against the evil the oppressive Internal Revenue Service that
the top 1% get away with it.
Yeah.
But now it's your
Is
turn.
this like the same guy that turns and looks the other direction when he gives you his business card?
Covers his eyes.
It's the look away. Yeah, it's the same. It's the same feeling.
Yeah.
It's the same awkward social feeling.
So I don't want to go into every little detail here, but there is a lot of abuse around different entity structure.
yeah, those are maybe let's name some of the common ones that we.
Yeah, I'd say anytime that someone comes and tells you that you can avoid paying taxes by setting up all of your corporations a certain way, here's one thing I can say definitively. The IRS wants between 20 and 40% of your income, no matter what.
And they're going to get it.
And they will find a way to get it. Now, if you find a way to make sure they don't get it, you're doing one of two things. You're either not making any money and you're just hiring people and expanding and buying stuff and growing a business, and eventually you'll pay a lot in taxes when you grow the business. That's legal. The IRS does not mind you not paying taxes if you're not making any money.
It's like that meme, the guy's pointing to his forehead. He's like, can't pay taxes if you don't make money.
Yeah. Yeah.
Yeah.
Now, if you're making money
and you're not paying
and somehow
any
you're not paying any taxes, so you're probably doing something that's in the old gray area, or you're a bit of an outlaw. You're finding the old legal loophole.
Yeah.
But I'm not good for you, I guess, Good for you. Good on you.
What is possible? If you're saying round numbers, if you're saying the IRS wants 20% of your income, or whatever, 30% of your income, and you manage to give them 28% instead of 30%, you probably did take advantage of things that were intended for you to take advantage of.
Give them some
through good planning.
Let's say 25.
25.
I mean,
okay?
you could save 5 to 6 points.
Just still very, very meaningful.
Yeah, it's a big deal. It means tens of thousands of dollars. It means, as much as $100,000 probably for many of you per year. Just taking advantage of the actual legal things you can do, and just be very cautious about following a strategy or someone who is invoking their ability to keep you away from.
Yeah, to eliminate it.
Let's talk about the next item in our list.
The free lunch. That's my favorite type of lunch.
Do you know the acronym for this one?
What?
No.
TANSTOFL.
TANSTOFL.
What is it?
There ain't no such thing as a free lunch.
Oh,
TANSTOFL. Really?
Cool.
I think this is going to go viral now because of that.
Hashtag TANSTOFL. Hashtag Q. Hashtag no risk, but all the return.
Yes.
At some point, you have to kind of recognize that every part of an investment has a cost. Or
any type of opportunity at all, right?
Yeah, any type of opportunity has a cost. And in investing, there are two main types of costs that you have to think about. Things you buy will change prices a lot, or they won't. And if you want to buy something that doesn't change its price a lot, it's not going to grow a lot. It won't go up. Like if you want to buy white flour, the likelihood of that changing price is not as great as
So what
gold.
you're trading there is you're gaining safety, you're lowering the cost you've got to pay in volatility, but you're giving up potential growth.
Yes. And so when everyone says risk return, it can kind of be confusing. It's like financial jargon. But I think when you say liquidity or access to my money, just say investing is about two principles. I can get access to the money, or I can have a stable price. Those are the two things I'm trying to compare. And it's either really accessible or not, or the price is going to be fast moving or not. That's the way to start comparing investments. And so if you want something that has a high return, you're really going to be inherently buying something that changes its price a lot. And
or runs the risk of not being able to get the money back.
Or
liquidity.
runs it, yeah, or and both. Because, the things that are going to give you a big change in price also have very low liquidity. And things that have lots of liquidity don't usually change their price a lot. So those are just two correlated variables.
I think the principle here that we just want clients to know is that, or anyone, right, is if you're ever in a situation where you feel like you're hearing something that's all upside and there's not a price you have to pay in any respect for it, question that, dig deeper on it, because there's a cost you're gonna have to pay in some form or another.
Yeah.
Okay.
Let's talk about one of my favorites, which is bold future
Jeez.
predictions about the world and the economy and markets.
So getting advice to make an investment decision based on a bold prediction.
Like,
for example,
let's say that someone says that we are about to have the biggest crash in the market since the Great Recession.
okay.
And you'd be like, okay, that's what I heard this week.
Yeah.
Someone was advertising that on TV. Or the worst decline in the Dow Jones in the history of the stock market. We've had the largest point decline in the Dow Jones index since the start of the market. Well, yes.
Points, yes.
Yes, because that is how the Dow Jones works. And the bigger it gets, the easier it is for us to have a large point decline. Like 1% today is very different.
Represents a larger percent. Yeah.
Yeah, it's 220 points instead of 180 points.
Yeah.
And so
it's like saying, like, I spend more money on groceries than I ever have at any point in my entire adult life.
Yes.
Which is true, but as a percentage, I spend less than I did 10 years ago.
yeah. Sometimes you'll hear big claims like this, and if you don't think through the logic, it can be like really scary.
Data can be misleading, even real true data.
Yeah.
Okay. So I guess the point of this, though, too, is that you making a major financial decision based on a prediction that's kind of like a big one-time event, world's going to end, market's going to crash, economy's going to, tank. It could, they do move in cycles. At some point, that person will be correct, The amount of times that the market actually does decline, it surprises people, but you can't make major life decisions based on a future prediction about, and like when that's going to happen too, you know?
Yeah, I think that I've seen that happen a lot recently with commodities, with oil, with energy prices. I think it's on both sides, someone saying that this market's going to decline and someone saying this market's going to recover.
Yeah.
Let's make a bold prediction about the future price of gold or about the future price of West Texas Intermediate crude oil. Okay. All of those
Texas guy, but
all of those prices and predictions, whether it's a stock prediction like an IPO or a currency prediction or the fate of an economy or a war, or you'll hear a lot of big, bold predictions. And those things tend to they make great headlines.
Mm-hmm.
And so people love to use them. People on Twitter share them. People in social media share them because a good headline that's trending is one of the best ways to draw attention to your article and your content and sell advertising. And so
Justin tries it all the time.
Yep.
Doomsday prophecy headlines.
Yeah, that's a restriction we have. It's not part of our code of ethics.
And that stuff spreads so fast among groups of friends and peer groups, though.
Yeah.
Like what starts out as a rumor of something that's about to happen, that'll spread through a group of a dozen friends or colleagues in the dental community in a city, and you'll hear it.
It's like wildfire.
Yeah, and they come to you like kind of like as if it's already happening, and everyone, because we always get brought in the conversation kind of at that point, when there's a lot of emotion worked up, and it's almost as if it's already happening and everyone clearly knows about it.
The consensus is already agreed upon. I think we all do this too. We say things
all the time.
That if we think back, we're like, do I really even believe that?
Yeah.
Is that really how I think? Is that really true? Or was I just emotional? And that just feels good to say that or to believe that, and it just feels comfortable.
Mm-hmm.
So don't make investment decisions on really bold future predictions that might alter the landscape of the financial market.
Yeah,
that's not a good way to invest money. Yeah. Last one that I like that is probably the most common offender and the warning signs of bad advice is when someone comes to you and pitches you an opportunity, and there's literally like the worst financial documentation.
The worst being none.
That you've ever seen. I mean, there'll be like an email with some words, okay? So technically, there is no financial documentation.
Can
but
someone pitch an opportunity in
it's
GIFs?
with in
Memes
words
and GIFs? Like they're
yeah,
not,
yeah, it's a meme.
yeah.
So there really needs to be good financials in order for a business to operate. And the reason those should exist, here's why. Why do good financials exist? Well, they exist for two reasons. Either someone had to make them up to meet some compliance rule or
Which has
raise
happened,
money.
Enron.
So, that's probably a lot of the reason why you might be getting financials from someone, is if they're wanting an investment from you and they've had to come up with something to give to you so that you could kind of like look at it and be like, oh, that's cool. And you'll know when it's that one because it's really pretty. And it's like got logos and color, and it's got some pretty
High gloss?
High gloss.
Okay.
It's in a PDF.
Yeah.
Well, it's got a cover sheet. It's like really, really ornate usually.
Okay.
That's when it's like for show.
Okay.
When it's like real
When data
financials,
is really boring.
it's usually because someone
Stapled.
actually is using it to operate with, or they actually make decisions with the numbers.
Huh.
They're looking at the numbers and actually they are making hiring decisions based on their numbers, or they're making overhead decisions, or they're cutting bonus checks based on their numbers. They're using it to calculate payroll.
Yeah.
Right. I was just meeting with a dental practice yesterday, and the owner of the practice has a spreadsheet that he, keeps to track all of his like payroll expenses for his own use, and all of his marketing expenses and everything. And it's what he uses to cut checks to his associate, and how he decides what profitability is. And
Shout out to our fellow spreadsheet warrior.
Yeah. And so that financial document I really trust because he's using it to make actual
There wasn't
decisions.
a marketing team that made that.
Well, there
for you to
wasn't.
look
There
at.
wasn't a step in between him using it to operate his business and then one to raise money and sell to me. I'm just looking at the real numbers.
Yeah.
And so I think that's when you can kind of tell when something's healthy or when something's real, is when it's a P&L that someone sends you that might not have, maybe the categorization is just a mess and you don't understand what's going on, but it's probably real numbers that they're actually using.
That would be common in like a acquisition or a transition.
Yes.
Where one practice is giving the new buyer the numbers, and it might, like, you look at the P&L and you're like, man, this could be a lot more specific or categorized better, but those are the numbers.
Yeah. And you should have more confidence, the more clarity, the more organization someone has around their financials. But you shouldn't be scared of someone who has financials that they're using to operate and that aren't perfect. It's not about like having perfect financials or having like perfect profitability or, perfect overhead categorization or perfect metrics. But, usually what we're talking about here, we're not talking about like just buying a dental practice. I mean, that's one investment. We're really talking about putting capital into a separate investment.
Yeah, and the hard ones are the privately held kind of investments and companies, those are tough.
And those comes up a fair amount. All of you are going to have an opportunity at some point in your life.
But
to
those are the
invest in
pretty
it.
packets. Then that's what's hard, and they're filled with numbers and data, and those are like the really nicely bound, high gloss cover sheet.
All the numbers probably end in 0.
They're all round.
Yeah,
all of them.
Yeah, that's a good insight, Q. You'll be amazed. When something is a fake assumption when everything is ending in some round number of some kind. Because what happened is it's literally a piece of data entry. Like no number in the world is like really perfectly round. No overhead item, no budget estimate. It's always like an actual number that ends in an odd or even number, and it's usually not 0. Yeah. So when you see like forecasts and projections that are pretty numbers and they're all rounded and they look great, just don't trust them because it's not real. And what you should really trust is actual operating financials from businesses, and every operating business that's worth investing in should be able to show you both their past performance and their assumptions for what they're going to do in the future.
And how those assumptions are being made, though, too.
Yeah, and they shouldn't be dramatically different from what has happened in the past.
Yeah.
If a business has had X percentage of growth in the past, and then just by getting your money, they're now forecasting like triple the growth rate that they've ever had. That's a problem because business doesn't usually work that way. It's incremental progress. Even when money is brought on, there's some waste. You're going to invest money in a company, and that company is going to unfortunately waste a good chunk of it on mistakes that they're going to make. They're going to misuse it. You're not going to deploy it completely efficiently.
Yeah.
So it just, I think real numbers that people are actually using is a real good way to know if you've got like something you can make a decision off of. And so any business that you're trying to invest in, if it doesn't have clear financials or documentation, if the person's not being really transparent with you, just walk away from it. So
Okay. All right. I found an old proverb. It just says proverb. I want to say Chinese proverb because it just sounds like it's more fancy and probably more wise.
That's true.
But the proverb says, "A danger foreseen is half avoided." Meaning, like if you can just see some of this stuff coming, you've done half of the work right there.
I like that quote. A danger foreseen is half avoided. And I think in advance of making any mistake, if you can see what's coming down the pipe, you're going to be able to make a lot better decisions.
Okay. We would really appreciate, this would not be a mistake on your part. We would love if you would go to iTunes and leave us a little review.
For the love of everything holy.
When you Google our podcast in iTunes, there's a lot of awesome dental podcasts out there, and to help people find us better, there's like the little parentheses in how many reviews people have, and we would like our number to be bigger.
Yes, and if you do review us, please send us an email. Send one to Ryan at dentistadvisors.com. Tell him you sent a review.
Yeah.
And he will go out of his way to provide you with a free benchmarking report. How about that?
How about that? Do that. Review us on iTunes, and I will go out of my way.
Yeah.
Which is very
like
vague,
that.
but I will go out of my way to provide that. So, yeah, rate us on iTunes.
How about a savings rate benchmark, burn rate benchmark, tax rate benchmark?
Whatever you want. What do you want to know? I'll benchmark it.
Okay, do an iTunes review, and Ryan will do some
and email
awesome
me.
benchmarking
iTunes
for
review,
you.
Ryan at dentistadvisors.com. If you want to call us for any questions, or if you have complaints, you ask for Reese. If you have questions, you want to be nice, you just call me.
Yes.
Or Q.
Ryan handles the easy stuff. I handle the tough
I
stuff.
only talk to the nice reporters.
Phone number?
833-DDS-PLAN.
833-DDS-PLAN.
Give that a call. Or if you'd like to just book a phone call online, you can go to dentistadvisors.com. Right at the top, there's a link for our calendar. Book a phone call at your convenience on your schedule, and we'd love to hear from you.
We'd love to help you save all of these warning signs of bad advice.
Yeah.
Make sure you get pointed on the right track.
Actually, that would be really fascinating. If you are in the middle of an opportunity and one of these or any of these warning signs are kind of,
on your radar.
on the radar, call us. Let's talk about it. It'd be
Love
really interesting.
debunking any bad investment. I love finding good ones.
Yeah.
May end up taking it away from you, though, and
We
investing
might
it
ask
on
you
our
to
own.
sign a disclosure so we can repeat it on the air. Anyway, thanks for listening. We appreciate it.
Carry on.